You've spent decades building your business, investing in real estate, growing your corporate assets, but without a plan for the capital gains on death, your family could lose a huge chunk of that to tax. And that's where life insurance comes in. It's not just for income replacement, it's one of the most powerful estate planning tools that's available in Canada. Hi, my name is Laurent Meunier. I'm a partner and advisor here at Safe Pacific, and in today's video, we're covering how permanent life insurance can help to neutralize your capital gains liability to keep your business or your real estate in the family and turn tax into a legacy. For many Canadians, especially business owners, real estate investors, or incorporated professionals, one of the most significant tax events happens not while you're alive, but when you die. Yet it's often one of the most overlooked parts of your financial plan. So when you pass away, the CRA, or the Canada Revenue Agency, assumes that you've sold all of your capital property at fair market value on the day you died. So this is called a deemed disposition. So even if no actual sale occurs, the CRA treats it as if you cashed out your entire portfolio, triggering a tax on everything that must be paid before your estate can be settled and before any of your family is going to receive any money. So this can result in a massive capital gains tax being owed by the estate. So this reduces the amount that your family or your beneficiaries will actually receive. So if you want a more detailed breakdown of how does capital gains work in Canada, well, you can see our other video that's going to be linked in the description, or you can click on the link that's going to be on the screen here somehow. Here, I don't know. So capital gains are triggered automatically on death. And this is what it means in real life. So capital gains are considered realized on applicable assets. This is the official wording. So 50% of the gain is taxable, and then that amount is added to your final personal tax bill. Those taxes must be paid before your estate can distribute any sort of assets to your beneficiaries. And this applies to a wide range of capital properties. So this is for sure on your real estate, rental properties, cottage, vacation home, even the principal residence after it's been passed to your spouse. So you're allowed to pass your principal residence to your spouse once, and then after that, if it's going to go to the kids, then it becomes taxable. If you have any shares in a private corporation, so it's your operating company, your holding company, doesn't matter. Any non-registered investment accounts, any stocks, ETFs, mutual funds, GICs, any sort of investments that you own, any corporate assets. So if you own your office building or any sort of real estate, any securities held inside the corporation, any corporate investment accounts. So depending on the size of your estate, this capital gains bill could be thousands, tens of thousands, hundreds of thousands, or millions of dollars, especially if you're passing on a business or if you've got any sort of real estate portfolio, so you've got multiple properties. And the consequence for your estate and the consequence for your family, like unless you've really implemented a proper estate plan and tax mitigation strategy, they could face, well, like how are they going to pay the taxes? They could face forced liquidation. So they could have to sell real estate or sell shares or sell some of these stocks to cover the taxes. And are they selling it at the best time, at the best price? And are they selling it in a stressful situation where you've just died and they probably want to be thinking about other things and not selling a house? There could be probate delays. So these are legal hurdles and tons more unnecessary stress at a difficult time because none of this can go through until the taxes are paid. This could really lead to family conflict or at least disputes because, well, maybe not every member of your family has the same financial resources. So some people might be able to pay the taxes and some people might not be able to pay the taxes. The taxes do get paid out of your estate, but you're going to have different people that want different things. And again, this lack of estate planning or lack of clear financial planning can help to amplify these disputes. It also probably will cause a major erosion of your legacy, right? There's less wealth to be passed on to the next generation and more wealth sent to the CRA. And how does this affect Canadian professionals? How does this affect business owners? So if you're incorporated, if you're a professional, you're a business owner, you're a real estate investor, which is a lot of people in Canada, or you're just generally got a higher net worth, this tax burden could completely undo years or decades of your wealth building work. Without a strategy in place, your estate may not have the liquidity that's needed to pay the tax bill. And this is where life insurance comes in. So this is as a capital gains relief strategy. Life insurance is a tax-efficient tool that's used by some of Canada's wealthiest families to preserve and to transfer wealth across generations. And this is how we're going to talk about how that strategy works. And how does life insurance offset capital gains in Canada? So the capital gains can take a huge chunk, a major bite out of your estate when you pass away, especially when you own real estate, when you own your private corporation shares or any sort of appreciating assets. But there is a proven and a CRA compliant strategy that many Canadians use to mitigate this burden, and it's called permanent life insurance. So when it's properly structured, the life insurance doesn't just protect your family, it becomes a powerful estate planning tool and a tax planning tool. And here's how it works. So number one, a tax-free life insurance payout can cover those capital gains. So having a permanent policy that lasts as long as you do, right? So this could be a whole life policy or a universal life policy, or even a term 100, that will pay a guaranteed tax-free death benefit directly either to the beneficiaries or to the estate. So this lump sum payment can be used to pay the capital gains that's triggered by this disposition on death. And what does this mean? Well, it means that your family doesn't have to sell property. It doesn't have to liquidate investments. It doesn't have to dispose of the business shares. It means that the tax bill can be covered by a pre-planned insurance proceed. So you don't have to emergency figure out how to come up with the money. It means that the full value of your estate can pass to the next generation intact instead of the CRA taking it. So in essence, life insurance provides that immediate liquidity at death at the exact moment that your estate needs it the most. Now, if you have a corporate-owned policy, you've got corporate-owned life insurance, and this can credit what's called a capital dividend account or a CDA. So if you have assets inside what's called your Canadian Controlled Private Corporation or your CCPC, or if you have it in a holding company, your estate could be hit twice. So you could have capital gains on shares of the corporation when you die. You won't have capital gains. Your estate will have capital gains on the shares of the corporation when you die. There could be taxable dividends when those funds are distributed from the corporation to whoever you want, to your heirs or your beneficiaries. This is where having a corporate policy can help because it gives you a double advantage. So when the corporation owns the policy and you pass away, that death benefit pays out tax-free to the corporation. And this credits what's called a capital dividend account. So it creates the capital dividend account and puts money into it. And it allows the company to distribute those funds tax-free to the beneficiaries of the corporation, which ideally you've done the planning in advance, and probably those beneficiaries are going to be your family or people that you want. And then your family can get that money tax-free from the corporation without triggering huge personal income taxes for themselves. So this is one of the most powerful tools in the Canadian tax planning world. And it's used by affluent entrepreneurs, all our clients like dentists, doctors, lawyers, accountants, consultants, software engineers, and just business owners in general and professionals to transfer their wealth efficiently. And I haven't even talked about it, and privately. You also want to have this life insurance as part of what's called your post-mortem tax planning. So life insurance is often used in tandem with advanced post-mortem strategies. Talk to your accountant about this, but you can have what's called loss carryback planning. So this uses losses that you can trigger at death to offset capital gains in your final tax return. You can also have what's called pipeline planning. So this converts corporate retained earnings into capital gains instead of a taxable dividend. So it could reduce your overall tax. You can have estate freezes. So this would be locking in value now and transferring the future growth to whoever's taking over those shares, which would probably be your family or your beneficiaries. With permanent insurance as part of the structure, these strategies are easier to implement, more effective, and they offer greater certainty that your family will have that cash when they need it, because they need it right now. Because when you pass away, those taxes are due on the next tax file, like in April. That's great that your family might be able to come up with the money over a couple of years, but the CRA wants it now. They're going to get it before the estate can give out any money. So your family's not going to receive any money until the CRA gets theirs first. So now why does this matter if you're a professional, you're a business owner in Canada? Well, you've probably built up some assets. Ideally, you probably have real estate holdings, you've got business equity, you've got retained earnings inside the corporation. The capital gains tax is not going to be optional. It's going to happen. It's inevitable. So without the strategy, your estate could lose 25 to 30% or more of the value to taxes because there's no way to pay it out. So having this properly structured life insurance policy acts as a tax-sheltered asset during your life, and it acts as a capital gains offset mechanism on death. So the insurance will pay the taxes for you, so you don't have to sell stuff, or you're gone, but so your family doesn't have to sell stuff in order to pay the taxes. So this is something that we specialize in. We design these customized insurance-based strategies for business owners and professionals and incorporated entrepreneurs in Canada. If this is important to you, if it's not important to you, don't worry about it. But if you want to protect your estate from this capital gains erosion, if you want to get your corporate money out of the corporation tax efficiently, if you want to pass on a tax-free legacy to the next generation, and now we'll talk about real-world examples and show you how this can work in practice. So here's one example of using life insurance to offset a $500,000 capital gains tax bill. So, I'm not just making this up. This is what happened. Obviously, I'm going to change the exact numbers and I'm going to change the names just so you don't know who we're talking about. But to really, truly understand how life insurance can act as a capital gains relief, here's like a simplified scenario. Let's say it's you. So you're a Canadian business owner and you've got your holding company and you've got your operating company. So inside the company, you've got around $2 million in unrealized capital gains that you've built up over the years. And this is from real estate. So this is a couple of commercial spaces that you own. You've also got corporate investments in there. So you've got a corporate investment portfolio that's inside the corporation. So the potential risk is a $500,000 tax bill that's due on death. So when you pass away, like I was saying, the CRA treats your capital assets as if you sold them all at fair market value today. And this is what we call the deemed disposition. So the capital gain, let's say, is $2 million. So you have the 50% inclusion rate. So $1 million of that is added to your final tax return. And it's taxed at your top marginal tax rate, which varies by province. But for just simplicity, it's 50%. So you have a $2 million gain. Half of that is taxable at 50%. Your estimated tax bill is going to be $500,000. This is a simplified example. I know that the accountants are probably going crazy right now that this is just very general, but just for illustration, this is $500,000 that your beneficiaries need to pay. And how are they going to do that? Are they going to sell investments? Are they going to borrow money? Is it a good time to sell the investments? Are they up? Are they down? So let's look at a very easy solution. You could have a corporate-owned life insurance policy for this $500,000. So let's say that your holding company has the $500,000 life insurance policy on you. Here's what happens when you pass away. So the policy pays out the $500,000 tax-free to the corporation. This amount credits your capital dividend account, or your CDA. And then the CDA allows the corporation to distribute the $500,000 tax-free to the corporate beneficiaries, which would be ideally your family. So this means no forced asset sale, no probate delays, and no unexpected CRA tax bills, right? And this is just a very simple example of how a high-income Canadian can use life insurance as a tax-efficient estate planning tool. It protects your legacy, it provides liquidity, it ensures your family inherits wealth and not tax debt. It also ensures a little bit of harmony in the family because we're not panicking on trying to figure out how to pay this bill. The $500,000 was allocated to this because we knew the tax bill was going to come. We didn't know the exact number of what the tax bill was going to be, but, say the tax bill ended up being $510,000 instead of $500. Well, you're better off having the 500 and coming up with the 10 than having to come up with the whole 510 yourself. Let's wrap this up. We're getting long here, but plan ahead to keep more of what you've built if it's important for you to pass this on to the next generation. Capital gains in Canada is one of the most significant and one of the most underestimated threats to preserving your wealth across generations. Now, the government is going to tell you the exact opposite. This only affects the 1%, Yeah, no, it doesn't. Anybody who dies in Canada that has any sort of assets is going to have this bill. So that's whether you're a successful business owner or a not successful business owner, if you're incorporated or not, if you're a professional or you're an employee. Especially if you're a real estate investor, you better listen to this. Your estate could face tens of thousands, hundreds of thousands, or millions of dollars of tax that's due on death because of this deemed disposition rule. So what's the good news, right? I just scared you. So With the proactive estate planning and a properly structured life insurance policy, you can turn this liability into a powerful legacy tool. So here is what that right plan can help you to achieve. Number one is you can offset the future capital gains tax. So you can use these tax-free insurance proceeds to pay the CRA liabilities on these assets, your corporation shares, your real estate, your corporate portfolio, or whatever. It creates immediate probate-free liquidity. So the life insurance bypasses delays and legal hurdles. It doesn't have to go into your estate. It can pay directly to beneficiaries. It can pay the corporation. It can also pay to the estate. It gives your family or whoever your beneficiaries are, if you don't like your family, it gives them access to money when they need it the most, and it gives it to them quickly. Most life insurance companies in Canada are going to pay out a death benefit within 7 to 10 days. And that's almost all of them. It can help to protect and to preserve your family's wealth over generations. So you avoid the forced sale of a property or of a business or of a portfolio, because you can now use the life insurance money to pay the taxes instead of having to sell one of the buildings or, the cabin at the lake or at the mountain that you have gone to Christmas with. You've gone to Christmas every year for the last 50 years and you don't want them to have to sell it. It also allows you to withdraw funds tax-free from the corporation, because we were talking about earlier about the capital dividend account, or the CDA. The insurance proceeds can be distributed to the beneficiaries of the corporation tax-free. And this is one of the most efficient strategies for corporately held assets. Please ask your accountant about capital dividend account, or CDA. Accountants love it. Now, you want to work with experts that work with Canadian business owners and that work in the estate planning world, right? So this is what we specialize in. We help high-income Canadians. We help incorporated Canadians to build wealth, to protect it, and to transfer it eventually tax efficiently. So if you're a business owner that has money inside the corporation, whether that's an operating company or a holding company, if you're a real estate investor, this is definitely going to apply to you, because you probably will have some unrealized capital gains when you pass away. Or if you're an incorporated professional that's planning an exit strategy or retirement. So we can help you to design a custom plan that includes life insurance, that includes tax optimization and corporate structuring that's tailored around your goals, around your values, around your family. The really easy way to get in touch is to book a consultation with us on our website, Safe Pacific Financial. There's a contact form there. There's buttons all over the website that'll get you there. If you fill out the form and send us a message, somebody is going to get back to you within 1 business day. You can also book directly into our calendar. We've got a calendar on the website that you can just schedule into, and we can start to talk about this. Another advantage of working with us versus others is that we are very collaborative in how we work. So we want to talk to your estate planning lawyer. We want to talk to your accountant. We want to make sure that the plans that all of your professionals are putting in place work together, and that we help to benefit the plan versus try to fight against it. So we want to work with all these things. Again, if you got some benefit from today, if you learned about capital dividend account, if you learned about deemed disposition on death, if you learned about how expensive capital gains can be when you die, well, please do me a favor. Hit the like button, hit the subscribe button, hit the notification bell if you're watching this on YouTube. And if you have any questions, put them in the comments, and I'm the one that actually replies to those, so I will reply to those. All of these things that I'm asking you to do really help the algorithm to share this with more people that are like you, because it's tough to find successful business owners in Canada that have money that they want to transfer to the next generation. There's not a lot, right? We are a minority. So all of these things help to spread the message further inside this small group of people. So, and if you know anybody who's going through this right now, please share this video with them. Anyways, that is it for me today. I will see you next time.